Okay, good morning, students. Today we are going to cover a topic under the chapter Advanced Financial Management. The topic name is Foreign Exchange Exposure and Risk Management. And I am CA Pravesh Avi, your faculty for this lecture. So let's begin. So first we are going to talk about the market, the foreign exchange market. This topic is a bit, a difficult topic in CA final. But if you understand all the basics well, then of course you will be able to do all the questions very easily. Okay, so please focus. Today we are going to just cover the basics about how to understand the forex markets. So a forex market is what? It's a market in which participants can buy, sell, exchange, and speculate on currencies. So that means if you want to buy dollars or euros or yen or any currency, if you're an importer or if you're traveling abroad, so you have to buy currencies, okay? Then you can even sell currencies. If you're an exporter, you're going to get, your money from abroad, which will be in terms of dollars or any other currency you have to sell. You can exchange and speculate on currencies. Now, in forex, in stock exchange market, you can even speculate in dollar. Suppose you're bullish in dollar, the dollar is likely to go up, or any other currency. You can be either bullish or bearish on currencies, so you can take speculative positions and make money without any underlying position as an exporter and importer in that case. So if you have any questions, you can always keep putting them on the chat box. So the forex market is made up of what? First of all, we'll talk about the market participants. Who are the people who participate in these forex market? They are banks, commercial companies, central banks, investment management firms, hedge funds, and retail forex brokers and investors. Now, banks, generally, they are the people who deal in foreign currencies. Suppose I'm an importer or an exporter, I have to make some payment abroad. So I always approach a bank to make sure that I make a payment in terms of dollars or any other currency. The banks always helps me. Okay. Similarly, if an exporter, I am getting some money from abroad in terms of dollars, so I would like to convert the dollars into rupee in India. So the banks do the job. Commercial companies, these are the companies which are looking for the or participating in the forex market by way of selling their dollars or buying the dollars through the banks or brokers. Then we have the central banks, like we have Reserve Bank of India or Federal Bank in America. Now, their job is basically to regulate the market and keep reserves, forex reserves for the government. Like, so today we have close to about $600 billion of forex reserve in India. So the Reserve Bank of India makes sure that the country is having enough reserves to meet out their export and import requirement. And also they regulate. They regulate because they want the dollar and rupee, or talking about Indian terms, to maintain, that there is a volatility of dollar versus rupee is maintained. It's not very high, very low, so that it doesn't impact the Indian economy. Then investment management firms. These firms, if you talk about foreign firms, they come to India and invest, so they convert their dollar into rupee. So they need the help of, they participate in this market for converting their foreign currency into Indian currency, or other way around, if investors are investing abroad, so they need to convert their rupee into dollar or any other currency. Then hedge funds. Hedge funds are basically, they are risky. They venture into risky, kind of businesses like startups or new companies. So they also basically, when the foreigners invest in startups in India, so they need to convert their dollars into rupee or any other currency also into rupee. So hedge funds also are participants. And the retail people like us, retail, or retail brokers, whenever we need money, we always go to a broker when we are traveling abroad. So we, go and buy, dollars or pounds. Okay. Then, now most of the countries of the world have their own currencies, like the Indian rupee in India, US dollar, the euro in Europe, the Brazilian real in Brazil, and Chinese yuan in China. So every country will have their own currency. Now, to trade between each other currencies, we require a market. So trading of currency is what makes up the foreign exchange market, because every country has its own currency and they need to, do imports and exports. So they need to come to this market to convert their currencies into the currency of the required currency. Now, the forex market, we must understand this very important part of our understanding. The forward market or a forex market is made up of two levels, the interbank market and the over the counter market. Now, in any market, when you go, you have a wholesale market and a retail market. Similarly, in forex market, we have the interbank market, which is like a wholesale market where the banks trade among themselves. There's a very large market, and the other market is called over the counters, where the commercial companies or people like you and me or individuals, when we need dollars, we go to the over the counter market. Okay. The interbank market is where the large banks trade currencies for purposes such as hedging their foreign exchange exposure, facilitating international trade, managing their investment portfolios, and speculating on currency price movements. Now, let's again read this. Interbank market is where the large bank trade currencies for the purpose such as hedging. Now, suppose if I am an importer or if I am an exporter, I've got dollars with me. Okay. Suppose it is like $1 lakh. So I'll go to the bank and give this dollar to the bank and convert those dollars into Indian rupees. So that means I've sold my dollars to the bank. Now, bank will immediately go to the interbank market and sell those dollars which they have received from me. So they'll not keep any exposure on their shoulders. So this is called hedging. So suppose they have sold the dollar to me at 83 rupees 20 paisa, but they will buy at say 83 rupees 5 paisa and make money out of that. So that process is called hedging. It can be done either in the spot market or in the forward market. Okay, so they also help us to facilitate international trade and speculating in currency movement. Now, normally the banks don't speculate, but in India particularly, maybe in other markets, world, they will be doing it. So, but they can also deal in currencies and speculating. Now, OTC market is where individuals trade through online platforms and brokers. So this is the retail segment of the market where we always go to the online platforms and interact with brokers for buying the currency of our choice. Suppose I'm importing something to England, so I need pounds, or if I'm importing something from US, so I need dollars, or if I'm importing from Japan, so I need yens. So these are the market where people who require dollars other than the banks themselves, so they go to the OTC market. So it's a decentralized market where participants buy, sell, and exchange currencies directly with each other with the help of an online platform. They are doing it directly without any centralized exchange or clearinghouse. So they don't require any centralized agency or like stock exchange or a clearinghouse. So they are doing it online. Suppose I require dollars, so I will go to the broker either through online platform or go to his shop there and buy dollars. So this is kind of a directly the participant, they go and exchange currencies, or if a company is there, they can go to the bank or they can ring up a bank or go to the online portal of a bank and purchase foreign currencies without the help of any regulator or any exchange house or anything, any clearing house. So this is all done directly. So can you please explain a little bit an example? Okay. So there's a question coming here. Now, I was just telling you, suppose suppose I'm a customer, I'm a company. Okay, I have got some dollars from abroad. I am an exporter, so I got $1 lakh. So what I'll do, I'll go into the bank and convert it in Indian rupees. Suppose that today the rate is say 83 rupees 50 paisa, for example. So the bank will say 83 rupees 50 paisa will give you per dollar. Okay. So now the bank has taken dollars from me. Okay. Now banks, don't maintain dollars inventory with them normally. So they will immediately like to dispose those dollars in the interbank market by, selling those dollars. Suppose they sell that dollars at say 85 rupees at 20 paisa. So they make 30 paisa profit on that. So they're hedging themselves. They're not keeping any exposure on their shoulders. So they immediately, whether it's a spot transaction, whether it's a future forward transaction, they do it, hedging. So either they will sell in forward market or buy in the forward market, depending upon who am I, whether an exporter or importer. So they don't keep any exposure on their hand. So they immediately do that. So should they, I hope I've answered your question. So let's move on. So what are foreign exchange rates? Now, there are two kinds of exchange rates which are there in the forex market. One is called the spot, another is called the forward. Now, whenever we require, dollars or any other currency, for our immediate requirement, either we are an importer or an exporter. So we go to the bank or a broker and buy, our choice of currency on the day itself. So that will be called spot transaction. That means immediate buying it. Now, spot transaction, if you read through this slide, spot transaction refers to buying or selling of a foreign currency pair. That means it can be US dollar versus an INR, a currency pair, for immediate delivery or settlement. Typically within 2 business days. Suppose I go to a bank and want to buy dollars, so bank will say, okay, give us the money and we'll give you the dollar. Now, all this transaction is closed normally in T+2 day, or it can be done in T+0 also. So this is called a spot transaction. Now, what is a forward transaction? Now, I may require dollars not today, but I may require it, say, after a month or after 3 months or after 6 months. Suppose I have got an order, import order, and I have to make payment after 3 months. So I'll go to the bank now and say that I need dollars. When? After 3 months. So bank will give me a rate today, so that I'm hedging my transaction. Now, today, the rate is close to about 82 rupees 90 paisa. Today, when I checked, it is 82.90. Suppose the payment is going to fall in the month of June. So I don't know whether the rate will remain the same. Normally, dollar appreciates against the Indian rupee on a long-term basis. So it may go to 84. So I go to the bank and bank says that I'll give you the dollar at 83.25, for example, today. So I'll immediately, accept and enter into a contract with the bank to buy dollars in the month of June at, say, a rate which is fixed today, which is 83 rupees, say 30 paisa, as against 82.90, which is the spot rate today, because I don't want any kind of an exposure, currency exposure on my business, because I'm doing my business. So I want to be, focusing on my business, and I want to make money only from business and not because of the volatility of the exchange rate. So I like to hedge myself. So in that case, I will go into the forward market and buy, any currency of my choice. If I'm an importer, I may buy dollars or yen or euros. So this is called a forward transaction or a forward transaction. So we'll understand this more in detail later on. Then the foreign exchange rates. Now, forex rates are published daily in the newspapers and internet sites such as www.finance.yahoo.com and many sites. Now, exchange rates for a currency such as rupee are quoted in two ways: US dollar per unit of domestic currency or domestic currency per US dollar. So let's understand that. For example, yesterday when I saw the screen on 24th of February 2024, $1 was quoting at 82.86. Okay, so this is normally the Indians will look at 82.86. Suppose I want to buy dollar, so I have to pay 82 rupees 86 paisa to buy $1. Now it can be also quoted as 1 rupee is equal to dollar 0.012067. Now how this has been arrived? By taking 1 divided by 82.86. So if I do that, I'll get 0.0. So this is the reciprocal of the first quote. Okay, so as an Indian, I will be focusing on this rate 82.86. But as an American, I will be, if I have to buy rupee, because if I'm in America, I need rupee for importing certain things. So I'll be looking at this rate. Okay, now there is a site on which we can, go and see. So this is the site, so which I have given a link, so you can just copy it. I don't know whether you will be able to see through. So if I just put this, so I get, this site. Are you able to see that site? Okay. So here, if you look at, then we find that, $1 today is trading at 82.8627. Normally, the currencies are quoted up to 4 decimal places. Okay. Now, I can also convert this into, a rupee code, INR to dollar, which will be just the reciprocal of it. So I get 1 INR is equal to 0.01206. I hope is it visible to all of you. Namrata, Shruti, can you just confirm that? Okay, so this is there. So now I just convert this back into my original quote, which is the direct quote in India. I go to INR. Okay. No, sir. Okay, so I need to show my screen. Okay. Now I think it should be visible after a while. Yeah. Can you just confirm now? Okay. So I'll just share the slide where I am. So this is basically a site here, which is telling me the rates. Okay. Can you, is it visible now? So one US dollar is today trading at 82.86. Yes, sir. So is it visible? Not visible? No visible. Okay. So, if you look at USD INR rate, so today the rate is 82 point, this is February 25th. The rate is one US dollar is 82.8627. Normally, the currency pair, Indian rupees is quoted up to 4 decimal places. So that's a norm. Okay. And these are the interbank rates. And these are called the mid rates. Okay. We'll talk about what are the mid market rates later on. So today, the dollar is trading at 82 0.8627. Now we can always convert into the indirect quote also, like INR versus dollar. So when we look at this quote, we find one INR is equal to so many dollars. Okay, fine. So this is, normally an American will look at this quote. Suppose he's traveling to India and he wants to buy dollars. Okay, so he will say how many dollars I have to pay per one Indian rupee. But when we are an Indian, so we will be focusing on this rate, INR rate. So for us, the rate is 82.86. Okay. Now let's see one thing. Let's go to, the chart. Look at this chart. Okay. Like look at, 1 month chart. Now in 1 month, if you look, the dollar was, around 83. Today it is, 82.86. So what has happened? The dollar has depreciated. So it's a very unusual kind of a thing when the dollar depreciates. It's a dollar which is appreciating over the long time history. But in this 1 month, we find that rupee was very strong and the rupee started appreciating it. Maybe a lot of money was coming in India in form of, foreign investments, and which has created more demand for Indian rupee as against dollars. Our economy is doing very well when we have a low inflation compared to US dollar, where it is close to about 4%. So there are many reasons for it. Now let's look at, a 10-year chart. Let's look at the 10-year chart. Now you'll find this pattern. The dollar has been always appreciating against the Indian rupee on a long. Yeah, I'll talk about your query. Okay. So first, just focus here. Here it is, the dollar was 61 rupees 10 years back, and today it is 83. So dollar has been moving up over a long time. Why so? Because the inflation in India is higher than America. Now, over the last few years, barring just last 1 year or 2 years after the Ukraine war, the dollar has, the inflation in America was less than 2%. India, it's almost like 6%. So dollar appreciates to the extent of about 4% on an average, if you see the 10-year pattern. Okay, but nowadays, the rate of inflation between India and America has narrowed down. It's close to about 1.5%. So that's why in the last few years or last 1 year, we find the dollar is not appreciating to that extent what it used to be in a historical perspective. Okay, so now I'll come back and I'll explain this thing. So I'm just going back to my, slide. Okay. So I'll answer a question which Shruti has asked. Okay. So Shruti has asked a question. Yes, and no. So, I told you that, the first quote, if you look at, the dollar is, at the right at the bottom, the dollar is 82.86. Now, this is a direct quote for Indians. And 1 rupee is equal to so many dollars, which is the second quote, is an indirect quote for Indians. But if we just flip across and see it from the US side, then the first quote becomes indirect quote for the Americans, and the second quote, which is 1 rupee is equal to dollar so much, becomes a direct quote for America. And I'll just tell you how to identify a direct quote and indirect quote when we move a little bit forward. Okay. Yeah, so you ask a question, only because of inflation. Normally that is the reason, but the dollar versus rupee changes because of the demand and supply, which is currently in the market. Okay, but the fundamental reason is basically the inflation rate differential between the two countries, which will lead for dollar to appreciate against the rupee. If the inflation in America is less, and in America, in India, it is more. So dollar is going to bound to appreciate, okay, because the dollar is not going to lose any value in terms of rupee, okay. So whatever you can buy in India for $1, you will be able to buy the same after 1 year. Okay, so the dollar is there's no problem with the dollar. It is the problem with rupee because rupees, we are having a high inflation in India. So it is a interest rate differential. The dollar will get changed, and the dollar purchasing power remains the same. So Americans generally would regard the exchange rate with rupee as $0.012067 per rupee, or you can say 1.2067 per 100 rupees, while Indian think of it as 82.86. Okay. And so we are going to talk about more about the inflation and other things in our next slides, maybe tomorrow. Okay, so we are going to cover that, why the currencies, why the dollar always appreciate, and what is the main reason for that. We'll cover in our coming days. Okay, the exchange rates are quoted for spot transaction or for forward transaction, so which we have already done. So how is the foreign exchange traded? So one of the most fascinating things about this market is that there is no brick and mortar marketplace for forex trading. So there is no particular office where it happens. It is basically transactions are done electronically over the counter. Okay, fine. Unlike the stock exchange, the forex market remains open round the clock with currencies traded across every time zone 5 days every week. So for 5 days, 24 hours basis, the foreign exchange market is open. It starts early in the morning at Hong Kong. Then, the baton is passed on to London market. When the London market is closing, at the same time, the American markets are opening. So the market remains open all throughout the day for 5 days in a week. And it is electronically over the counter. Everything is done digitally. So there is no place you can say there's an office or one particular place which you can design as from all the trading happening from there. It is happening world over. Okay, so now, we suppose, for example, we have seen that, after Ukraine war, the inflation is in America is going up. Suppose it happens that, the inflation in America is more than India. I mean, it's a highly unlikely chance because the Americans are trying to bring down the inflation. So in that case, the rupee is going to always, appreciate against the dollar. But that is a very unlikely situation. But as we have seen, in the last 1 month or last 1 year, the dollar has not, moved up so much against the rupee because, we're finding that even the inflation in America is close to about 4%. And if you look at the bond rates in America, they're close to about 4.25%, as against about close to about 6% in India, or maybe 7% in India. So the foreign exchange or the forex market is the largest financial market in the world, larger even than the stock market, with a daily volume of $5 trillion versus 85 billion for the equities worldwide. Now, this was when I prepared this slide, it was quite long term back. Now the daily volume is close to about $7 trillion per day, almost double of the Indian economy, GDP. And this market is the largest market in the world. So if you look at this, the dollar versus rupee from 1947 to 2021 chart, and of course, next chart I have made up to right up to 23. So you see the dollar was just 4 rupees 76 paisa in 1947. As we speak, today it's about 82.90. So we have seen that the dollar is always, increased, or the dollar has always appreciated against the rupee. There were, of course, few times when, in 2007, if you see, the dollar has, depreciated from 43 to 39. But barring these times, over a yearly basis, the dollar has been always appreciating, just because the inflation rate differential is too high between India and, America. So So I can't see your chat line at the moment because my system has rebooted the other one. So once it open, then I can see your chat and answer your questions. So let's understand some basic questions. Okay, basic concepts. Now these are very important. Just bear with me for the chat, because I'm unable to see your chat because my other system is, updating. So it will take about, I think, a couple of minutes so that I can just view your chats again and understand your queries. So basic concept. So we talk about direct quote and indirect quotes. Okay. So foreign exchange quotation can either be a direct quotation or an indirect quotation, depending upon the home currency of the person concerned. So a direct quote is home currency price of 1 unit foreign currency, like $1 is equal to 83.18. So this is a direct quote. For whom? The Indians. So if you have to identify whether it's a direct quote or indirect quote, look at on your right hand side. The currency which is appearing on the right hand side is actually the home currency. Okay, here it is basically a direct quote in terms of rupees for buying $1. Okay. Now, if you look at the indirect quote, it will be in this like. So we have already covered that. So 1 rupee is equal to 0.01202. How do you do that? By dividing 1 divided by 83.18. So you come to this rate. Okay. Now that means the direct quote is equal to 1 divided by indirect quote. Okay. So look at this direct quote. So direct quotation is when the 1 unit of foreign currency is expressed in terms of domestic currency. When 1 unit of foreign currency is expressed in terms of domestic currency. So you look at $1 is equal to 83.17. Okay. So if you want to buy, $1, you have to pay 83. So my chat line is now my system has actually booted. So I'm just, logging in games. Just give me 1 minute. Just give me 1 minute. I'm just, opening my chat line so that I can be in with you. Okay. It's taking some time. So I'll just move on. So I'll come back to your, this thing. So as soon as my system gets fully functional. So £1 is equal to $1.24. Now here, basically, if you look at this code, which means that, this is the direct quoted which country? America. Because on right hand side, you see dollar. So an American would like to, go and buy £1. So the price of £1 is equal to so many dollars. So this is a direct quote for USA. Okay. Now this will become an indirect quote in England. Okay. Now €1 is equal to so many dollars. So this is also a direct quote in USA for buying €1. Okay. Let me just see if the chat line is still on. Queries. Give me just now. I think I should be able to do it. So I'm just there. Just give me 1 second, okay? I'm just coming back to you. Yeah, it's just opening. So just bear with me for just half a minute or maybe a few seconds. Yeah. Now I can view your queries again. Okay. Okay. Let me see if there's anything. Okay. Sir, could you please state the daily volume of fixed for the volume of forex market? Yeah, it's about close about 6.5 trillion today. Okay. So let's move on and I'll answer your queries. Now I can view your chat box. So indirect quote. So if you look at indirect quote is indirect quote is when one unit of domestic currency is expressed in terms of foreign currency. So like, for example, 1 rupee is equal to so many dollars. So it is an indirect quotation for India. Okay. It is a direct quotation for Americans. When you look on the right hand side, the dollar is there. So it will be direct quotation for America, but it will be indirect quote for India. So similarly, if you see $1 is equal to so many pounds, so here this is a direct quote, for what indirect quote for America, but a direct quote for England. Okay, so if a person in America wants to buy a pound, so he has to shell out 80 cents or 80.80 pounds for buying $1. Okay. So similarly, we have indirect quote for the Chinese yuan. So $1 is equal to 6.88 Chinese yuan. So this is basically an indirect quote. Okay, for in America. Okay, but this will be a direct quote in China for buying $1. Okay. So direct quotes and indirect quotes are reciprocal to each other, which can be mathematically expressed as simple. So, fine. Okay, when I talk about the bond rates, actually we are talking about interest rates. Okay, the bond rates, particularly the government bond rates, is the rate at which the government is borrowing money. If the inflation is around 6%, so government has to pay a little higher than that. So the bond rate today is close to about 7%. So bond rate and interest rate and inflation rates are all interlinked because the inflation rate will actually decide about the interest rate in the market. Okay, so at what rate the corporates can buy, at what rate the companies can buy or the government can buy will depend upon the inflation. If the inflation is very high, the interest rates are also going to go up. For example, in America, traditionally the interest rates were below 2% or even less than that because the inflation has been very low there. Okay, and the interest rates and inflation rates, they are absolutely linked, and the bond rates are nothing but the borrowing rate of the Indian government, particularly when we talk about G6. But there are corporate bonds also which are trading, so those are the bond rates also. So now direct and indirect quote, a little bit more. In a direct quote, the domestic currency is the base currency while the foreign currency is a quote currency. Okay, so the foreign currency is a quote currency. The $1 is the quote currency, and rupee is the base currency. Okay, and it's the other way around in case of a indirect quote. So now let's understand some practice questions. Okay, so I'll be showing you all these questions, and I'll be solving them on the board. I have a board at the back, but these are very simple ones. So for first few exercises, I'll be showing you on a slide. Now, for example, Euro 1 is equal to so many dollars. So this is what a direct quote in America. And how do you identify a direct quote? Looking on the right-hand side. So on the right-hand side, we find dollar. So this is a direct quote in US for buying €1. Now, we want to convert this into an indirect quote. So we want to find out what is the price of $1 in terms of euros. So please find out and let me know the answers on your chat line if you have able to do it. So you have to do simply the reciprocal of it. Okay, I'll wait for your response for a few seconds. So just tell me one dollar will be equal to how many euros? If €1 is equal to so many dollars, which is a direct quote in America, and to identify a direct quote, look at the right-hand side. The currency which is appearing on the right-hand side would be the home currency. So this will be a direct quote for US for buying what? €1. So now we want to see what is the price of $1 in terms of euros. So very good. Let's see. So it is 0.8250. Very good. Of course, they are not up to the right decimal places. So you are absolutely right. The answer would be is okay, 0.82. Now let's talk about this is a direct quote in Euro countries. Okay. Now let's say another question. Suppose 1 pound is equal to so many dollars. So which means this is a direct quote of which country? US. On right hand side, US dollar is appearing. So, if a person in US wants to buy 1 pound, he has to pay 1.26. Okay, fine. So now we want to calculate what is the indirect quote of $1 in terms of pounds. So please answer it. Yes, I think all have done well. Okay, just find out what is the price of $1 in terms of pounds. Let's see your answers. So you have to do the reciprocal. Yeah, I've got some answers. Let's see. So it is 0.79 something. Okay, maybe 5 it is right. So maybe I have done. So this is right. Okay, fine. So let's go to the third one. Okay. Now, 1 New Zealand dollar is equal to so many dollars. So this is the direct quote of what? US. How do we find out? Look at the right hand side. Why I'm repeating again? So many of the students may be joining late, so they can, if they are missed out. So that's why I'm for their benefit, I'm explaining. So if you have to find out whether it's a direct quote of which country, look at the right hand side. It is US dollar. So this is the direct quote of buying, 1 New Zealand dollar in terms of US dollars. So now we want to find out what is the indirect quote or a direct quote in New Zealand for $1. So please find out. So please find out this. Yeah. I think, yeah, some people have done it. 1.5239. Yes, absolutely right. Wonderful. Now let's go to the last question of this small one. $1 is equal to 75. So this is a direct quote of what? I mean, this was a quote which was there about a year back. $1 was equal to 75. So if you have to buy 1 rupee is equal to how many dollars? So how it would look like? Answer. Okay. Yeah. So yeah. Central Raw has done it well. 1 rupee is equal to so many dollars. Yeah, absolutely right. So now we yet move on to another kind of a basic American terms and European terms. So this is a very important concept. Okay. The quote can be either in American terms or European terms. Okay, let's understand. Currency pairs versus US dollar tend to be quoted in one or two ways, in either American or European terms. So we are talking about any currency pair versus US dollar. Remember, the other currency has to be US dollar. Okay, one currency has to be US dollar. Okay, so let's take American terms. US dollar price per unit of foreign currency. For example, 1 rupee is equal to so many dollars. 1 euro is equal to so many dollars. So this is American terms. Okay, if it is the quote is given like this, then this is American terms. And this is actually a direct quote in the United States and indirect quote outside the United States. If this is given, this is called American term. Okay. And if it is like this, when the foreign currency unit per dollar is given, that means $1 is equal to 83 or $1 is equal to so many euros. This is called the European term. A direct quote outside United States, but indirect quote in US. So this is called European terms. Now, what is the significance of this? We'll understand as we go forward. Okay, so this is a very important information and you must know it. Either the currency will be quoted in terms of American terms or European term when the dollar is involved. Okay, and the dollar is not involved, then we don't have American and European term concept. Okay, fine. Okay, now we'll understand the significance of the American term and the European term later on and how it is used, and I'll explain that again to you. Okay, so let's move on to yet another basic concept, which is called bid, offer, and spread. Okay, a forex exchange quotes are two-way quotes expressed as bid and ask rates. So whenever you go to a bank or a broker, normally you go to a bank, so they will give you two-way quotes. Okay, the bid is basically the price at which the dealer or the bank is willing to buy. So bid is the buying rate of the dealer and it becomes the selling rate of the customer. So I'll explain that more detail later on. The ask or the offer is the rate at which the bank is willing to sell another currency. So bank will give you two rates. Okay, it will be like this. So bid is the buy rate of the bank, and ask, sell or offer, all the meaning the same thing, means the selling price. So let's understand this through an example. For example, a dealer may quote Indian rupees as rupees 82.80-82.90 vis-a-vis dollar. So $1 is equal to 82.80 dash 82.90. So he has given you this quote. So the dealer doesn't know whether you need dollars, or you want to sell dollars, or you want to buy dollars. So he'll give you two quotes. Okay. So which means that if he wants to, the 82.80 is his buying rate, and 82.90 is a dealer's selling rate. So if you want to buy, or suppose if the dealer wants to buy from you, so he is going to charge you 82.80. If dealer is going to sell to you, he is going to charge you 82.90. Okay. That means he is willing to buy the dollars at 82.80. Or from your perspective, you want to sell rupees and buy dollars. Okay. So he's going to actually charge 82 rupees 80 paisa. So that means if you are selling, you will be getting 82.80. And the dealer is buying, he will charge you 82.80. While he will sell the dollar at 82.90. So when he buys, he gives you a higher rate. When he takes dollar from you, he gives you less rate. So the bid is always lower than the ask. Ask is his selling price and bid is his buying price. Normally, just to understand this concept again, if you are an importer or you require dollars, so then the rate for you will be 82.90. But if you have dollars with you and you want to sell them because you got some export order and you want to convert your dollars into Indian rupees, then this guy is going to give you 82.80. For importers, it is the ask rate, and for exporters, it is a bid rate. So an exporter will get his money at 82.80, and an importer has to pay more, which is 82.90, because he's buying. Okay. So difference between the bid and offer is called the spread. The offer or ask is always higher than the bid, as the interbank dealers make money by buying at a bid rate and selling at the offer rate. Okay, so let me see here. Okay, so I'll answer your question, Shruti. Just, when we do some questions on the American and European terms, so I'm going to answer you. So first, just focus on this bid and offer. Now, the bid and offer, so you will get always two-way quotes, okay, which will be 82.80 and 82.90. Suppose that was the rate on that day. So 82.8 will be the bid rate and 82.90 will be the ask rate. So bid rate is the rate at which the dealer is going to buy from you. And if you want to buy from the dealer or you want to sell, then his rate will be 82.90. The dealer sells the dollar at 82.90 and buys at 82.80. So just to repeat, if you are an importer, you need to buy. Okay. So, or the dealer need to sell. So that means his rate will be 82.90. And if you are an exporter, that means you need to sell your dollars, or the dealer is buying from you. So he's going to give you 82.80. So 82.80 is his buying rate. So an exporter, he's going to buy the dollars from me. So he's going to pay 82.80. So as an importer, I'm an importer. So he is going to charge me 82.90. So this is a very important information. Importer, yeah. So importer is the ask. So importer will look at what rate? 82.90. An exporter will look at what rate? 82.80. Always remember that. And there'll be a lot of questions we'll be doing where we'll be using this knowledge. So by the time we cover all the topic, you will have a complete, understanding, and this concept will, settle in your mind. So if you want to buy currency, you have to pay the higher price. But if you want to sell the currency, you have to sell it at a lower price. Okay. So which means the bid is lower, which is your selling price, and you want to buy, so you have to pay ask price, which is the higher price. So if you were to buy a currency, then immediately sell it back. on the same to the same dealer, the dealer would make money and you will lose money. So that doesn't require any explanation. Thus, the spread is the transaction cost of the trading currency. Okay. Now you can look at it from your own perspective as a customer perspective or from the dealer perspective. So you should be able to understand from both the perspectives. So the bid rate is the buying rate of the dealer. So that means your selling rate. If you sell, the dealer buys. Okay. Similarly, ask rate is the buying rate of the dealer. So your, that is his, buying rate, and you are selling him. Okay, fine. So bid and ask. So let's go back here again, and this is bid and ask. So ask is 82.90. So as an importer, if I need to buy dollars and he's going to sell, so he's going to charge me 82.90. 82.80 is his bid rate. That means his buying rate. Okay, so we'll understand it. Let's not get confused. We'll understand as we do some questions. Okay, so let's understand this. Okay, so please focus here. Okay, and then you'll understand. Okay, suppose now they are going to do some questions, and there'll be some questions that will be thrown upon you. George is an American businessman visiting Europe. The cost of purchasing euros at the airport is as follows. Suppose you find suppose there's a person called George. He's an American businessman. He's visiting Europe. Okay, so he goes to the airport and he finds that 1 euro is equal to USD, that is dollar 1.2. So this is the bid rate, and ask is 1.3. Now he wants to buy 10,000 euros. He wants to buy 10,000 euros. Okay, so what is the price he's going to pay? He's going to pay the higher price because he wants to buy and the dealer would like to sell. So his selling rate is ask rate is 1.30. So the higher price, which is 1.30, is the cost to buy each euro. So he would have to pay a dealer the ask price, which is this. Okay, fine. So 10,000 multiplied by 1.3. So this is what you have understood. Okay, fine. So now do this question. Okay, John is an American traveler visiting Europe. The cost of purchasing euro at the airport is 1.20 oblique 1.30. George wants to buy 15,000. How many dollars he has to pay to the dealer? Okay. Please answer this question. So there are two quizzes I'm going to put to you. So answer, yeah, you were right, Mansha. It is 10,000 to 1.3. So answer this question. John is an American traveler visiting Europe. The cost of purchasing euro at the airport is 1.2 US dollar oblique 1.30 dollar. George wants to buy 15. How many dollars he has to pay? Okay. Yes. So Mansha said 19,500. So answer is 19,500. Absolutely right, Mansha. So now the second question. Okay. John is an American traveler returning from Europe. So John is an American traveler who is returning from Europe. The cost of euro at the airport is same. George now want to sell 3,000 euros. So he has gone to America. So he purchased, euros, and he is left with some 3,000 euros back with him. So he's returning back from Europe. So he wants to sell these euros. So how much money is going to get? Yeah, you're right. You're right. Absolutely right. So let's answer this question. Yes. Chandra Rao says 3,600. 3,600 is the right answer. So Kushma has done it right, sorry, and Shruti, you've done it right. And B, which is you also done right. Saresh and Chandra Rao, we also done right. Also done right. Okay, let's go back. Now let's understand some rules. Okay? Very important rules. So the first rule is, if suppose there is a direct quotation which is given to you and you want to convert a direct quote into an indirect. Okay. So, so bid price indirect will be equal to 1 upon ask direct. So you have a bid and ask price of the direct. So you take the ask price and do the reciprocal of it. It will become the bid price in the indirect quote. Similarly, the ask indirect will become 1 upon bid direct. Okay, so just focus on this and understand this. Very simple. Just understand the formula. Okay, it says if you want to convert a quote from a direct to indirect, just do the reciprocal of the quote, but interchanging from ask to bid. Now, 1 upon ask will become bid indirect. So take the direct quote, look at the ask price, and do reciprocal of it. It will become the bid rate. Similarly, look at the direct quote, look at the bid price, and do the reciprocal of it. It will become ask indirect. Okay. Okay. Actually, I've seen the comment is actually read earlier, so no problems. If you are able to get, understand the thing, it's good for me. Okay. So bid price. So let's understand this. Okay. I'll answer your question since we have moved on, Tanisha. So we'll come back to this. Okay. So example. Now suppose $1 is 80/81. So 80 is the bid price and 81 is the ask price. So this is the quote given to you. Okay, so it's a direct quote for dollar in India. So we know that this is a direct quote for dollar. Suppose we want to buy $1. Okay, so the quote is 80 and 81. 80 is the bid price and 81 is the ask price. So if you want to, buy the dollar as a customer, you have to pay 81. But if you have a dollar with you and you want to sell it, you will get 80 rupees only. So I'm just explaining for your benefit, Tanisha. Just try to understand. I mean, to this example, your own question. Suppose you find the rate of dollar is 80/81. So 81 is the bid price, and 80 is the bid price, and 81 is the ask price. Now look at. I mean, I'm trying to explain from the customer's perspective. Suppose you are going and you want to buy dollar. So you look at this rate, how much price you're going to pay? 81. But if you have a dollar with you and you want to surrender the dollar and convert that back into Indian rupees, you're going to get 80. So your buying rate is 81, whereas the dealer selling rate is 81. Look at from the dealer angle, it is his selling rate and it becomes your buying rate. Similarly, 80 is your selling rate and it becomes a bid rate for the dealer. So if you are an exporter and you have got dollars with you, the bank is going to give you only 80 rupees and not 81. But if you need to have dollars to go abroad or import some things, you have to pay 81. So that I think covers them. Yeah. Got it. Now we want to convert this quote from a direct into indirect quote. So what we'll do? We will do the bid rate will be 1 divided by 81. Okay. So we'll go to the ask rate and convert it. And similarly, when you are to ask this thing, so we will go and convert this into 1 divided by 80. Okay. So this is bid price is equal to, ask. And so look at the screen. So what I have done is I have just, applied the formula or the rule. I have converted them into different quotes. Okay. So the bid price is for the trader is always lower than the ask price. So you must know that when you just solve this, you will find it is coming like this. Rupee 1 is equal to so many dollars, 0.01234 and $0.0250. Now look at the pair again. The ask is more and the bid is less. Bid is always lower than the ask. So, even after, calculating the indirect quote, you'll find the parity has been maintained. Okay. Fine. So now a question for you. Okay. Now $1 is equal to so many pounds. So it is the bid and ask rate for, now this is which quote? This is a direct quote in England for buying $1. Or alternatively, it will be indirect quote in America or a direct quote in England. Okay. Now you want to convert this into a quote in terms of dollars. Okay, £1 is equal to so many dollars. So you want to convert that. So you are making a this is a direct quote in England and you want to convert into an indirect quote in England or a direct quote in America. But the same thing. So $1 is equal to £1 is equal to so many dollars. So do this. This is an exercise for you. So apply the rule and do it and let me know what's the answer. So if $1 is equal to so many pounds, the first quote is bid and the other one is asked. And now you want to convert a direct quote in England to an indirect quote in England or a direct quote in America. Okay, the second would be a direct quote in America. When we say £1 is equal to so many dollars, so this is also a direct quote in America, but it will become indirect quote in England. So we are converting a direct quote into indirect quote in terms of, the country England. Okay, so find out, yeah. So let's see. So the rate is 1.303 and 1.325. Absolutely right. Absolutely right. Wonderful. So now let's do another question. Suppose €1 is equal to so many dollars. Now this is a direct quote of which country? America. For buying what? €1. So an American wants to buy €1, so he has to pay $1.2100 or 1.2150. This is a bid and ask rate. Now we want to know indirect. We want to convert this into an indirect quote. That means what is the price of $1 in terms of euros? Okay, so please do that. Yeah, Kushma is also right. And okay, so only thing is that Kushma and Krishna, you have to give both the bid and ask rate. You haven't given that. So Shruti has given it, but Shruti has just given the opposite. Shruti, it should be the other way around. What Namrata? Let me just go back and see. So it is 1.3203 is the right answer, and 1.3253 or 4. It's okay. So that is the right answer. So Namrata and Prashant, you have done absolute right. Shruti, you need to do just the jumbling of it. Okay. So I think you have made there a mistake. Fine. So okay. So now let's move on to this question where it was. Okay. So this is the answer is 0.8230, 0.820, and 0.8264. So Harsha, you're right, absolutely right. Namrata, you have just done the you have just the jumbling one. You have to just change the positions of the numbers, then otherwise okay. Prashant has also done it right, and Kirti has also done it right. Salesh has also done it right. Absolutely right. So I think you're following now. Okay. So let's understand now the most important one and the most difficult one. Okay. So let's just focus. Understanding the Forex quote conventions. Of course, unfortunately, there is no convention in the world. Every country follows their own convention of, putting their quotes. But we must know and how to, whenever in a question, a problem is given, how to interpret a quote. So this is, rightly interpreting a quote. So we refer, for example, please listen carefully now, a very important one. So $1 is equal to ₹80. Suppose this is the quote given, okay, with no bid and ask here. So we refer $1 is equal to rupee. So this quote can be written as rupee-dollar quote. So on the numerator side, it will be rupee. On the denominator, it will be dollar. So this can be written as rupee/dollar. Okay, so this is called rupee-dollar quote. So I'll just pause here. $1 is equal to ₹80. Suppose this is the quote given to you. This will be called rupee-dollar quote in India. Okay, where we write rupee as a numerator and dollar as a denominator. So let's look at another way. Thus, a dollar-pound quote is written as pound/dollar, dollar/pound, which means £1 is equal to so many dollars. Suppose the quote is written like this, dollar/pound, it means how much £1 is equal to how many dollars. So relate with the first box, you'll find it is the same thing. Okay, where the numerator is dollar and denominator is pound, which means we are referring to a direct quote in US for buying £1. Now, the code can be also written like this: $1.32 oblique pound, which means 1 pound is equal to so many dollars. Okay. Yeah, you are right. It is rupee per dollar. Here, rupee per dollar. Yeah, you are right. Okay. Now, again, 1 euro is written as 1.21, is expressed as, now this can be again written as $1.21 oblique euro. So the codes can be written in many ways, but you must understand how to interpret the code. So if it is 1 euro is equal to $1.21, now this can be written as $1.21 oblique euro. So which means 1 euro is equal to how many dollars? Okay. Now where the problem comes. If a problem carries a reverse notation, it becomes challenge to solve them. Since we are used to familiar with the normal quotation, so we can understand, our mind is tuned towards understanding the normal one. But once it is given in the other way around, so then we get confused. So how do we do that? So to overcome this problem, if we know through journal knowledge, how many units of one currency should be another currency. Now I talk about journal knowledge. Okay, so I'll explain you what is journal knowledge. In my second slide, I'll explain what is this journal knowledge. Okay, so I'll explain you how to improve your journal knowledge to understand the codes. So just bear with me for a few seconds. In the next slide, I'm going to show you. For example, if it is given as dollar oblique rupee, quote as $1 is equal to rupees 80, we know this is a reverse quotation because this is called rupee oblique dollar and not dollar oblique rupee. Suppose in example, it is given dollar oblique rupee and the quotation is written as $1 is equal to rupee. So rupee should be numerator and dollar should be denominator. But in question, it is given dollar oblique rupee and the quote is given like this. Suppose it is given like this. So we know that it's absolutely a reverse notation. It is not written properly. Okay. Similarly, if it is given, now the problem comes only when the currency is other than rupee. Okay. So, okay, so just stay with me. Similarly, if it is given, so you'll be understanding when I'll be doing some questions, Anisha. So you'll be understanding. Similarly, if it is given that the euro oblique dollar is 1.1, it is a reverse notation because this is telling you that $1 is equal to so many euros. Okay, but we know that $1 is not equal to more than, I mean, you can't buy more, euros from $1, but from 1 euro, you can buy more dollars. Okay, because euro today is close to about 100, for example, 90, and dollar is close to about 80. Okay, so I'll explain that in my next slide. So if this quote is written that euro oblique dollar is 1.10, which means that 1 euro is equal to $1.1 and not $1 is equal to so many euros. So how do we know that? Basically, I'll come back to this slide. Look at this journal knowledge. Okay. Now, we know that, this is the rates in January 24 when I picked up. 1 yen is equal to how many rupees? 0.57 or close to about 60 paisa. 1 Singapore dollar is what? 62.39. 1 Australian dollar is 55. 1 Canadian dollar is close to about 62. $1 is close to about 83. 1 euro is 91. And 1 pound is 105 or 106. Which is the costliest currency today? Pound, 105. Second, euro. Then dollar. So the dollar is 83 and euro is how much? 91. So if you go back again, so if you look at the last box, 1 euro is equal to 1.1. So this is right. In 1 euro, you have more dollars because if you see, the dollar is 83 and euro is 91. So if you have 1 euro, you will get more dollars, isn't it? But not like this. $1 is equal to, 1 euro is equal to so many dollars. The code should be not like this. $1 is equal to so many dollars. If you convert this, code, then you will find that $1 is equal to so many euros. So you may, make a mistake and think that $1 is equal to. So in $1, you don't get more euros, but in 1 euro, you get more dollars. So this is by your knowledge, okay, that the euro is costlier than your dollar, okay, and the pound is more costlier. Okay. Fine. Okay. So now we will do some questions so that you are able to not able to understand. Okay. So you will be able to understand now. Okay. Let's understand this. Now, this is the quote which is given to you. Given that the yen oblique dollar is 145, is it a normal or a reverse quotation? So let me answer this question. It's a normal quotation because we know that $1 is 145 yen. You know what is the price of a rupee? $1 is close to about 83. And the yen is just 50 paisa, 60 paisa. So in $1, you will get more yen, isn't it? 145. So this is absolutely a normal quotation. Okay. Because if you look at the here, the yen is just 57 paisa and the dollar is, yen is 57 paisa and the dollar is 83. So just going by this knowledge, we know that the $1 you will get more yens. Okay, fine. So this is $1 is equal to so many yen. This is the absolutely right way. Okay, so let me just give you one more quote here. Is it a normal or a reverse notation? So normally it would mean $1 is equal to so many yen. Is it right or is it wrong? Is it a reverse or a normal? Answer, please. Yes, you get an answer. I need some more questions so I can answer it. Today you'll understand, not able to understand the reverse notation. I take your point, and just try to look at this question on the screen that $1 is equal to so many yen. And we have seen that in $1 you get 145 yen. But this is telling you that $1 is equal to 0.0669 in dollars. Okay. So which means that this quotation is it a reverse? It is a reverse notation. Reverse. Absolutely right. Simply, now you got it. It's a reverse. Okay. Because we know that 1 yen should be equal to 0.0069. Okay. Because we know that 1 rupee is equal to 0.00 something dollars. So this has to be reversed. Okay. Just one more question. Suppose it is given that 1 Singapore dollar SGD, which is Singapore dollar, oblique dollar is 75. Is it a normal quotation or a reverse quotation? So $1 Singapore dollar is equal, $1 is equal to 0.75. So is it a reverse? Yeah, absolutely right. So, reverse quotation. Yeah. Is a normal or a reverse quotation? So we know that in $1, now, let's just look at here. So what is the Singapore dollar? 62. And what is the dollar price in India? 83. So, Singapore dollar is cheaper than the Indian rupee. So that means you are going to get how much? Because we know that 1 Singapore dollar, you will get less. Okay, reverse. It's a reverse, not normal. Because, 1 Singapore dollar it's a reverse. So 1 Singapore dollar is equal to 0.75. Okay, so you get only 0.75. Okay, because Singapore dollar is just close to about 60 rupees or something. Okay, so you get less. So now, is that clear to all of you? So you can watch the video again if you have missed out. Okay, so let's come to some more practical questions. Okay, is that okay? I hope you are following up to now. Okay, good. So let's understand some more questions. So which I'll be solving them on the board. Okay, now. So let's understand the first question. Okay, the second one, which is on your assignment list. So given the following quotes, answer the following. Okay. So if 1 Canadian dollar is equal to 0.7703 dollars, how many dollars we get by selling Canadian dollars 10,000? Okay. Given the following quotes, answer the following. If 1 Canadian dollar is equal to so many dollars, how many dollars we get by selling $10,000? 10,000 Canadian dollars. So we have to sell Canadian dollars. We need CS code. Since we have it, we can use the code directly. So which means that we need to just multiply 10,000 Canadian dollar into 7703 to arrive at the number of dollars.
So very clear, yes, sir. Yes, sir.
This little bit more in my coming slides. Okay, Singapore. Okay, clear, sir. Clear. Okay. So yeah, absolutely right. So I think most of you have done right. 7730. Okay. So let's say the second. Now these are very simple questions. So I think I don't need to explain it on a board. So whenever there's a long question, I'll go to the board and explain. One yen is equal to $0.0093. Find how many dollars we get by selling so many yens. We have to sell, yens. We need yen code. Since we have it, we can use it directly and answer the questions. So when 1 yen is equal to so many dollars, how much will be the selling price of 20 lakh yens? Give me the answer. So this, I think you can solve it. Instead of my solving on the board, you can just give me the answer. 18,600. Absolutely right. Okay. So let's go to the third one. Now, this is a bit tricky, okay? 18,600. Every done it. Now, $1 is equal to 0.94 Swiss francs. Find how many dollars we get by selling 50,000 Swiss francs. Okay. Now, the quote is not in terms of Swiss francs. Okay. It is in terms of Swiss francs per dollar. So we need to convert this quote. Okay. And find out what 1 Swiss franc will be equal to how many dollars. So either do the reciprocal of it, okay, and find the answer. Since we have to sell Swiss francs, we need Swiss francs quote. Since we have dollar quote, we convert the direct quote into Swiss franc quote before using it. So answer this question. I think you should be able to do it. So this quote needs to be, we have to do the reciprocal of it because the price is for buying one or selling $1. But we need to actually sell 50,000 Swiss francs. So first of all, we need to convert this. We have to make a reciprocal of it and then apply our rate. Okay. Yes, let me see. Yes, it is. So the answer is 53,091. Okay, fine. So now we can do also one way. Okay, we can just divide 50,000 by 0.94. We'll get the same answer. Okay, so if we divide 50,000 by 0.94, we will get the same answer, 53,000. So either we can do it by converting them, making a reciprocal of it, or we can just simply divide 50,000 divided by 0.94. Okay. So because it is nothing but reciprocal. Okay. So let me just go to the second one. If 1 Singapore dollar is rupees 54.13, find how many Singapore dollars we get by selling 5 lakh rupees. Let's answer this question, please. Now apply your mind and do it. Yes, Manshal, you got it right. PT has also done it right. Prashant has also done it right. Not Shruti has also done it right. So you're following it. So now the question is 1 Singapore dollar is 54.13. Find how many Singapore dollars we get by selling 5 lakh rupees. Again, in this case, we have got the Singapore dollar code. So we have to convert that into rupee code. Either we convert or make 5 lakh divided by 54, we'll get the answer. 9327. 9237. Yeah, absolutely right. I think others would also be giving the same answers. So it is 9,237 dollars. Okay, select. Yeah. I think we have Singapore dollar. Yeah. Right. Okay. So let's go to the yet another question. Okay. Now $1 is equal to say rupees 68.61. This is a very old quote, about 3-4 years back. How many dollars we get by selling 25,000 rupees. How many dollars we get it by selling 25,000 rupees? Now, again, in this question also, since we are having a dollar code, we need to convert into a rupee code before answering the question, or we can just simply take 25,000 and divide by 68, we'll get the same answer. Let's see. 364, I think Shankara Rao has got it 364. Let's see. Yeah, 364.37 or 38 is the right answer. Absolutely right. Okay. So now one more question. I'll wait for your responses, all of your responses before I show the answer. Okay. Now solve this. Okay. 1 pound is equal to rupees 86.34. Find how many pounds we get by selling 25,000 rupees. So please answer this. Yeah, everyone has got the right answer. Very low, sir. Okay, fine. So I'll keep the computer at my level so that I don't you don't lose the. So I'll take care of that. Okay. So 1 pound is equal to 86.34. Find how many pounds we get by selling 25,000 rupees. Okay. So answer this question. So it is 289.5. Yeah. I think most of you have answered correctly. Okay. So now let's go to the another one. Yeah. So this is the last question, and then we come to the another topic. So 1 euro is equal to rupees 77.44. Find how many euros we get by selling 25,000 rupees. Again, the quote is in terms of euros. This is a direct quote of a rupee in terms of for buying 1 euro. So we need to convert that. Please answer. Now this is basically okay. You're right. Absolutely right. So 89. So 1 euro is equal to so many rupees. Find how many euros we get by 25,000. So answer is 322. 322.83. Yeah. All of you have done right. So let's move on to another chapter. Okay. So, but we'll do it and we'll have a break after 5 or 10 minutes. Okay. Fine. Or should we have a break now? So I think we should have a break now. And it is, according to me, it is around 8:20. So we will meet at around 8:35. Okay. 8:35 we'll meet again. So we are just breaking for about 15 minutes. Okay. Fine. Is that clear? So we are breaking for 15 minutes. Okay, students, so we are back after the break, and we are going to understand a very important concept now, which is called the cross rates. Okay, so these are the cross rates, understanding, which is used in solving most of your CA final questions. So please be attentive and listen to it carefully. Now, the cross rate, the exchange rate expressed by any currency pair that does not involve US dollar, or called cross rates. So whenever we are looking for any code where the dollar is missing, for example, 1 pound is equal to so many rupees. Now here there is no dollar. So this is a cross rate. Now why we call it a cross rate, we'll understand. 1 euro is rupees 90.55. So if you want to buy 1 euro, it is equivalent to 90.55. So which means that it is a direct quote in India for buying 1 euro. Okay. So similarly, all these quotes are having, no dollar sign. Okay. So these are called cross rates. Now, long back, very important to understand, and this is the knowledge which we'll be using in solving most of the questions in your paper, that, I'm just giving you some historical perspective here. When we used to travel abroad about 20 years back or 25 years back, we used to buy only dollars. Only dollars were available in India. So we'll buy dollars and then go to either America. Then, of course, we can always, buy from dollars what we have purchased in India. But if we are going to England, then we'll go to England and convert our dollars into rupees. Okay. Because only in India the dollars were available. So you used to necessarily buy US dollars and then go to your country of choice or your country of destination where you're going and convert your dollars into your home currency there. Suppose you're going to, for example, Dubai, then you convert into the Dubai currency there. Okay, the dirham there. So, or if you're going to Australia, you buy dollars from India and go to Australia and convert your dollars into Australian dollars in Australia. Now, that means, all the rates of all the other currencies are linked to dollars. Still, you get all the currencies in India. You want to buy, either Australian dollar or a New Zealand dollar or pound or euros. They are now available, and it always makes sense to buy these currencies in India and then go to that country rather than buying now dollar and going to that country. Okay, other country. So, earlier we used to always buy dollars, but now we buy the currency of the country in which we are going. Suppose we are going to England, we are going to buy pounds in India. Suppose we are going to, Germany, we'll buy euros in India. And it is always advisable to do that. Otherwise, you will be paying a heavy brokerage or commission charges, and you will not get good rates if you go to, say, England and convert your dollars into pounds there. So it is always advisable to do it in India. Now, so that means all other currencies are pegged to dollar. So we always arrive the rate of other currencies based on the dollar price today. Okay. So this is now done. Because everything is digitally connected. So we don't have to, do the same thing where we are buying, dollars in India and then traveling, because that time it was all physical world. Now it has become all digital world. So we can always buy the currency of our choice within our own country. So let's understand and let's see, how this knowledge will help you to solve questions. So cross currency is calculated by multiplying two exchange rates. Okay. The USD is the base currency in one of the pairing and the quote currency in the other pairing. For example, suppose if you're given these two quotes, $1 is equal to 83 rupees and 1 euro is equal to so many dollars. Now we want to find what is the rate of 1 euro in terms of rupees. So, let's understand that. So you will put this currency in this order. Okay. First quote is rupee dollar quote. So rupee upon dollar. Okay. The second quote is dollar oblique pound. So the dollar cancels out. So you get rupee euro quote, which means $1 euro is equal to how many rupees. So we can just simply multiply them and calculate the rate of 1 euro. Is that okay? Have you followed that? Okay. So here you have to put, now only one thing is that the first currency we're talking about should be European and the second currency should be American. Okay. Fine. So one currency should be in European code, another currency should be in American code. If this is in order, then you can just simply multiply and calculate the desired code. Okay. Now, just to give you the historical perspective, I have to find 1 euro is equal to how many rupees. So normally this will be which person will be interested in this code? An Indian, because he is going to travel to Europe and he needs to buy 1 euro in India. So this is a direct code of a euro, okay, in India. Now, first thing I'll do is what? I will buy dollars. Okay, so I should have a dollar code. $1 is 83. So this is a dollar buying rate. Fine. Then I go to Europe. I mean, historically, I used to always buy, dollars going to, Germany or other country where the euros are selling. So I'll go to Germany and buy 1 euro by selling my dollars. Okay. So the currency is perfectly matched. First, I buy dollars and then I go to Germany or the country in which the euro is, available, or the country. So then I buy euro by selling my euros, my dollars. Okay. Fine. So this is how we calculate. One is European, another is American. Okay. Now it may happen. Okay. Now it may happen that the quote is given like this: $1 is equal to 83, and $1 is equal to so many euros. If it is given like this, fine. So the first quote is what? The American, the European. The second is also European. So we can't calculate that. So either we convert this quote into an American quote and then we can calculate, or we can simply divide. If both quotes are either American or European, then we can achieve our formula by taking 83 divided by 0.90909. We'll get, now this is also European code, this is also European, and we can get the same answer by division also. If the codes are not according to one is European and one is American, we can still calculate by doing a division. Otherwise, always a better way would be to follow this mechanism, that think about that you are, an Indian and you want to buy euro. First, you're going to buy a dollar. So you should have dollar code. Yeah, you have a dollar code. $1 is equal to 83. Then you go to Germany and buy 1 euro. So you have a euro quote also in terms of dollars. So because you have dollars with you, you're going to sell dollars and buy euro. So you have both the currencies in order. So this is always the best way. Suppose the quotes are given in this order, the best would be to convert the second quote, okay, into an American quote. So convert that, by 1 divided by 0.9090. So you will have 1 euro is equal to so many dollars. And then you can just simply multiply. If you want to save time, you can just divide it. And if you have the full understanding about this thing, so you can achieve it like this also. So we'll understand this later more. Okay. Even if we find that it's a little bit difficult to understand, but as we do some questions, there also we're going to talk about that. In this case, both were European, so we couldn't achieve it. Okay, fine. So let's do this question. Yeah, it means we have to convert direct into indirect. Absolutely right. Yeah, you're right, Namrata. So let's look at this. Okay, there's so many questions which we'll be doing, and you will be able to understand Namrata very well. $1 is equal to so many euros. The first quote. The second quote is 1 yen is equal to so many dollars. Now you want to know what is the price of 1 yen in terms of euros. So basically who you are. Look at the right hand side of the last. 1 yen is equal to question mark euro. So you are a European and you're traveling to where? Japan. So you want to know what is the price of 1 Japanese yen, since you need Japanese yen. And when you go to Japan, you're going to spend Japanese yen, isn't it? So first you are going to do what? You're going to buy a dollar. Where? In Germany. So $1 is costing you so many euros. Then you go to Japan and buy Japanese yen by selling your dollars. So both the quotes are absolutely perfectly made. The first quote is which one? American or European? It is European. The second one is American. So both codes are okay. So you just simply, do this formula, euro upon dollar into the dollar upon yen, and the dollar cancels out. So it becomes, euro upon yen. So 1 yen will be equal to this much, 0.6. Yes. Absolutely right, Kirti and Amrita. So I hope you are following this. Okay. So let's now do one more question, and which you are going to do. Now, $1 is equal to 82. £1 is equal to so many dollars. Now you want to know the price of $1 in terms of rupees. First of all, whom you are, Indian or English guy? Are you from Britain? Normally, I mean, which will be the case of scenario? Most likely scenario, you will be Indian or an person from England. Answer me this question. So the answer would be that you are an Indian because you want to know what is the price of £1. So first, what are you going to do? You're going to buy a dollar. So look at the first quote, $1 is rupees 82. Absolutely fine. You can buy a dollar, you have to pay 82 rupees. Then you go to England and convert your, I'm just telling you historically, you know what we used to do. Okay. Now you don't have to do that now. So that everything you get it from India. So £1. So you are going to buy a pound by selling your dollars there. So you have both the quotes with you. Okay. And the first quote is what? The European, and the second is American. So absolutely fine. You can just calculate the rate. So it gives you a rate of 102.5. Oh, Shruti, you have got the wrong answer. So just check your answers here. Kirti, you have got the right answer. Prashant, you have got the right answer. So here, look at this. So you have, rupee upon dollar. So, just listen to me once more. Historically what we used to do. Now, of course, you don't do that. But if you remember the logic, you can just, solve the question. Many questions like that. Historically, we used to buy dollar in India. Then go to England and buy pound from there by, selling my dollars. So first, I should have a dollar quote in terms of rupees so that I can buy dollar. Then I should have a pound quote so that I can sell pounds, sell dollars, and buy pounds. So I have both the quotes with me. Okay. Now the quote says that I have to calculate £1 is equal to so many rupees. That means I am an Indian. I want to know what is the price of £1. So if you look at both the quotes, we can just solve them or put them into this equation, rupee upon dollar into dollar upon pound, and we calculate the price per £1 should be equal to how many rupees. Is that okay? Have you followed this? Okay. Now, let's look at this question. Very important. $1 is equal to 75, and $1 is equal to so many pound. So we have to calculate the price of a pound in terms of rupees. The same thing, but now, look at the quotation. The first quotation is okay because you need to buy $1. But now we need a pound buying rate, but we have a dollar buying rate, isn't it? So $1 is equal to so many pounds. So either we do it the reciprocal and convert it. So we can just convert that. Okay. Okay. We convert this and then we have both the quotes in order. So bring all the quotes. One American, the first one is European and the second one is American. Now we have everything in order. We can buy $1 by paying 75 rupees and then go to England and buy £1 at so many dollars. So now we can just, do this formula where we have the rupee upon dollar. So the numerator will be rupee and denominator dollar. Then the second quote where the numerator is dollar and the pound is denominator. So the numerator and denominator cancels out. The dollar cancels out. We have rupee upon pound, which means £1 is equal to this. 94.94. Okay. Your answers are right. My decimal places may be at the wrong places. Okay. Fine. So this is okay. Okay. Now we can achieve this by a different manner. So what we can do is that we can just simply divide. So how we can divide is we can, do is that I'm opening my, calculator. I can take 75 divided by 0.79. If I do this, I'll get the same answer. Look at this. Here I'm doing is, that's a change there. 75 divided by pound 0.79, I achieve the same number. Okay. So I can simply, convert that, or I can, without converting itself, I can calculate the rate. Is that okay? Now, some people can make a mistake. Instead of dividing 75 by 79, they can do the reverse of it. 0.79 divided by 75. So you will get an indirect quote of pound. So you have to convert that in a direct quote. So that is the only thing that we'll understand. We'll do some more questions so that you understand this also later on. Okay. So now just look at this question, okay, and solve this. $1 is euro 0.88 and $1 is 0.79. So what should be the price of £1 in terms of euros? Now look at both the quotes. First is who you are. You are a European and you're traveling to England and you want to buy £1. First, what you'll do, you will buy a dollar. Where? In your own home currency, that is, euro currency. Then you are going to go to England and buy dollar. Now the second currency is not in that order, so you have to change it. Just answer this. Just answer this. So I'll just explain again. Just listen to me once for again. Now we have to find the price of a pound in terms of euro. So on the right hand side, you have euro. So that means this is the home currency. So you are a person belonging to Europe, most likely. Okay. And you're traveling which country? England. And you want to buy a pound. So first, what you're going to do in your home currency, home country, you're going to buy a dollar. Then you travel to England and convert your dollar into pound. So the first quote is absolutely right. You can buy a dollar. But the second quote, you can't buy a pound because the quote isn't given in an indirect quote. So you have to convert that into a pound buying or selling rate and then solve it. Okay. So yeah. So you have got it right. So it is 1.111 something. Okay. Yeah, everybody's right. Or you can achieve this thing again by doing 1.88 divided by 0.79. Okay. So you get the same answer by division as well as by multiplication. Okay. Either you multiply or divide, you will get the same answer. But you have to be very careful that you divide the right number with the right number. So it should be 0.88 divided by 0.79, not 0.79 divided by 0.88. If you do that, then the only problem is that you have to, do the reciprocal of the answer and you will get the desired answer. Okay, so if you do 1.79, for example, I'm just doing on my calculator and you can also repeat it and tell me what are you getting the number. Suppose you just done the reverse of it. 0.79 divided by 0.88. Suppose you have done this. So you get 0.897. 0.8977. So what do you do? 1 divided by 0.8977. So 1 divided by 0.8977. So you'll get the same answer. Okay. So you get the same answer if you do 1 divided by. So I'll just, going to add here one more, slide so that you understand what I'm talking about. So this is the last question. So I'm just adding one more. Okay. So I'm adding another shape. Okay, here. So what I do is that I do just the reverse. Okay. So I do is 0.79. Okay. 0.79 and I divide it by 75. Suppose you have done this thing. So what you will get basically 0.8977. Okay. So the answer is not correct. So what you do is you do the reciprocal of the same back. So 1 divided by 0.8977. So you get 1.1139. Okay. So you achieve the same answer by doing this also. I'm just going to show you this. So if you have done, if you have done 75 divided by 0.79, it's okay, you got the right answer. But if you have done it wrong way, 0.79 about 78, so you have to reciprocate to get the answer. Is that correct? Yeah, absolutely right, Tanisha. You've got it. Okay, so 0.897, so you got it one. So you can, if you understand all the quotations well, you can do anything you want. Okay. So first, your basics should be absolutely clear. You know what you want to achieve, what you want to do. Okay, fine. So now let's go to the second one, the last one, and you can do it the similar way. This is, I think we have done, isn't it? No. So this we have done. So let's now go to another question. So the question is, these quotations are given to you. So let's go to the main example, the latest one. Okay, I'm just moving on to the latest one, exercise number 4. So you can just open your exercise. So we're going to solve it. I'm going to solve it on a board, okay, this time. So this is given that I'm just going to now stop share and go to the board, okay. So the question, tell me if you are able to, see the board, okay, fine. I'm going to show you on a PPT also. The question is $1 US. Sorry, I'm going to just $1 US is equal to yen 139. Is my voice clear now? Let me know that. So this is, first quotation which is given to you. And the second quotation which is given to you is £1 is equal to US dollar 1.16. I'm going to use a black pen. A black pen. Third one which is given is Australian dollar is equal to US dollar 0.68. Okay. I'm able to, board is not properly visible. Is it not visible? So, okay. So what I'm going to do is that I'm just going to show you on the slide. Okay. Let me just show you that. We'll handle this later. Okay. So this is the question. Okay. Okay, fine. Okay, it lowers the voice. So maybe that, there's some problem. So I'm going to just explain to you on a slide itself. Okay. Okay. So, $1 is equal to so many yen, 139.49. £1 is equal to so many dollars. $1 Australian is so many US dollars. This is the question. Calculate the cross rate for pounds in yen terms. The first question. Second, calculate the cross rate for Australian dollar in yen terms. Calculate the cross rate for pounds in Australian dollar terms. So these are the three quotations which are given to you, and you have to answer three parts to it. Calculate the cross rate for pounds in yen terms, which means if you have to calculate the price of a pound in yen terms, that means you are a Japanese guy and you are going to England. So you need a rate for pound, £1. Second, Australian dollar in yen terms. Again, you are a Japanese guy and you are traveling to Australia, and you need what is the price of 1 yen in terms of Australian dollars. Third, calculate the cross rate of pounds in Australian dollar terms. So pound in Australian dollar terms. So that means you're an Australian and you're going to England and you want to know what is the price of £1 per Australian dollar. Okay, so let's solve it. Calculate the cross rate for pound in yen terms. So you want to know this is the price. Okay, fine. So £1 is equal to how many yens? So now you have these two rates. $1 is equal to so many yens and £1 is equal to so many dollars. Okay. The first one is basically a dollar buying rate, which is in European terms. That means first you are going to buy a dollar. Where? In Japan. So $1 will cost you 139.49 yens. Then you go to England and buy a dollar from the dollar you have with you. So both the quotes are okay because the second quote is American, the first is European. So the quotes are in order. You can just simply do this multiplication and calculate the price. So it comes to 161.81. Yeah. Yes, you're all right. I mean, of course, sometimes you may not get the answer in the right up to the decimal place. Okay. £1 is equal to 120 yen. So Viraj, you need to just look at what mistake you have done. So have you got it? So this is how you do calculate the cross rate for pound in yen terms. So you need to find what is the price of £1 per yen. Now this is a direct quote of which country? Japan. Okay. So the Japanese person, most likely the Japanese person who is actually traveling to England and he needs a quotation of £1. Okay. So first, historically, if we look at from my logic, that now of course you don't have to do everything; it's digitally done. You can buy your pounds in Japan itself rather than buying a dollar and then converting your dollar into pounds in America. So you can just do it or rather converting your dollars into pounds. Okay. So first you need to buy a dollar. So in where? In Japan. So you need you need 139.49 yens to buy $1. Then you have to look at the pound rate and buy pounds. So you have dollars with you. So you now can buy pound from this. So you have both the quotes in order. The first quote is European and the second quote is American. Perfectly in order. So you can calculate that. Okay. I hope you followed. Okay. So now let's go to the second one. Calculate the cross rate for Australian dollar in yen terms. Okay. Now here, you are again a Japanese guy and you want to buy Australian dollar. That means you're most likely a Japanese person and traveling to Australia. First, what you are going to do? You're going to buy a dollar. What dollar quote is given to you? Then you go to Australia and buy, $1 Australian by selling your dollars. So one is European, other is American, and you can just simply use this formula and calculate the rate, which is 94.85. Absolutely right. Okay. Fine. Then we go to, so you get this rate. Okay. So I think most of you have got it right. So let's now go to the third one. Calculate the cross rate of pounds in Australian dollar terms. The first quote which is given is $1 Australian. Now this you have to find pounds in Australian dollar terms, which means that you are an Australian and you are traveling to England and you need the rate of a pound there. So first in Australia, you're going to buy what? A dollar. But the quote is given $1 Australian is equal to so many dollars. Okay. But this is not the right quote. So you have to convert that. Okay. So the second quote is that you're going to go to, England and buy £1 by surrendering your dollars, what you have bought in Australia. So both are American. So first you need to convert. So now, if you look at what you have to find, £1 is equal to how many Australian dollar, which means that you are an Australian and most likely, and you are traveling to England and you want to buy pound. Okay. So first you are going to buy a dollar. But the quote given to you is not in terms of dollar, but in terms of Australian dollars. Okay. So you have to convert that into Australian terms, dollar terms. Okay. Then just simply, buy a pound using your dollars. So you can just do the same multiplication and find out. So In the case of pound to yen, the currencies are not in the same base. Then could you please tell me why didn't we convert initially the dollar in pounds and then did the conversion? You're talking about, I think, the same question here. Pound. Acha. Okay, let's go back to the pounds. Okay, pound. You're referring to which part? A, B, C. Tanisha? Pound to yen. 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 So this you're talking about. Now look at this, Tanisha. Here we want to calculate the cross rate for pounds in yen terms, which means I want to find what is the price of 1 pound in terms of yen, isn't it? So that means who am I? A Japanese guy. I'm looking for to buy a pound because I'm going to travel to England. So I need a price of a pound. So in Japan, what I'll do first, I'll buy a dollar and I have the right quote with me. $1 is equal to so many yen. So this is the quote I always look for buying a dollar in Japan. So I have the right quote with me. Then when I travel to England, there I need to know what is the price of 1 pound in terms of US dollars. So I have both the quotes in order. One is the European, other is the American. So I can just simply achieve by multiplication of the two quotes and get the desired quote. I hope you have followed it, Tanisha. Okay, I hope you have followed it. So let's go back to this. And now, is this okay? Okay, so now we will do one more question. Okay, this is very simple, and I think you will be able to understand. If Tanisha, you are not followed, please focus here. You will be able to understand. Okay. Now, exchange rate in Mumbai interbank market. Let me see if I have an example. Look at this quote. Okay, this is the most recent one. If the exchange rate in Mumbai interbank market is US dollar is equal to 81.5750 oblique 5850. Okay. So in Mumbai interbank market, the rate of dollar is given to you, bid and ask. And in London interbank market, the rate of US dollar is given in terms of pounds. Okay, so this is given to you. What would be the exchange rate between Indian rupee and pound sterling for buying pounds? So you need to calculate the ask rate. Ask rate is when I need pounds, when I want to buy, pounds. Okay. So I need to have the ask rate. If I have to sell, I need to bid rate, but I need to buy pounds. So I should know the rate of pound. Okay. So first, what I'll do, Mumbai interbank market, we need to purchase US dollar. So I'm going to buy a US dollar. So here, the question is the dollar rate in terms of rupees given and the dollar rate in terms of pounds are given. Now, I want to know what is the price of 1 pound if I want to buy 1 pound. So first, I'm an Indian. I'm going to buy dollars. Mumbai interbank we need to purchase dollars by surrendering rupee and sell dollars in London interbank market to purchase pounds. So this is what we have to do. Okay, right? Okay. So first leg would be buy dollars and sell rupee. So I'm traveling to England. So first I'm going to buy dollars. And I have rupees with me. I'm going to sell and buy dollars. So the second leg would be buy pounds and sell dollars. First, I'm going to buy dollars and sell rupee. Next thing, when I go to England, I'm going to buy pounds and sell my dollar there. Okay. So what is the pound? What is the dollar buying rate? Now the two rates are given 81.5750 and 5850. Now I have to look at the ask rate, which is now I'm going to buy dollars. So I have to pay a higher price. So the dollars buying rate would be 81.5850. Okay. Fine. So this is the price of the dollar I have to pay. So what I have chosen, the ask rate, that is 5850. So this is the price which I'm going to pay for buying $1. Then I go to England and I see this rate. Now this rate doesn't help me. So I need to convert that into pounds because I need to buy pounds by selling my dollars. So the price would be what? 1.2128, isn't it? So this is the pound buying rate. Now I can just convert and calculate the price of the pound. So 1 pound will be costing me 98 point. Okay, fine. So it will be 98.94 will be the price of the pound. So this is the ask rate. I hope you have followed. So now I'll ask you to do this question, okay, yourself. Now look at this question, okay, and answer me this question. Now, if exchange rate in Mumbai interbank market is $1 is equal to 75.2550/2600, and in London interbank market, the rate of $1 is equal to this. Okay. Now tell me what is the ask rate or what is the rate of buying 1 pound in India? Just try to find out. If you want, I can explain again what I have done earlier. Or otherwise, you can do it. Or I'll explain through this example when I solve it. So tell me what should be the rate of buying 1 pound. What should be the rate of buying 1 pound in terms of rupees? So you say 94 point. Shailesh Mane says 94. So let me just check before we, 94.72 is the right answer, Shailesh. So others, please try. I'm just going back. Okay.
So we have to consider the direct port currency which we are selling. Namrata, we have to consider the direct port currency for which we are selling.
Yeah. So here we know we have to use the direct code, definitely. So you need to convert this into rather it is basically an indirect code of pound, okay, or $1 is equal to something. So this is basically an indirect code, not a direct code.
So just try to do it.
Yeah. Shruti has also done it. So she has got 94.38. Okay. So let me just, I think some people have tried their luck. So I'll just wait for 1 more minute so that I get some more answers. So Shailesh seems to have done right. Namrata, you did some mistake somewhere. And Namrata is basically just struggling a bit. So I'm going to explain that again. Okay. Fine. So now let's see this example. Now, exchange rate in Mumbai interbank market is US dollar 75.2550 and 2660. Okay. And in London interbank market, the rate is $1 is equal to so many pounds. Okay. Now we want to find out what is the dollar, what is the pound buying rate or what is the pound buying rate. Okay. So first I'm going to buy dollars. In India, we can do even that. Yeah. You got it absolutely right. Okay. So first we are going to buy a dollar. So first leg is to buy a dollar. So I know what should be the price of a pound in terms of rupees. So first I need to buy a dollar and sell my rupees. Second, I'll buy a pound and sell my dollar. So this is what I have to do. Okay. Fine. So I have $1 is equal to 75.2550 So what is the buying rate? 75.2660. This is the buying rate. Okay. So when I approach to the dealer, he will give me $1 at 75.2600. 0.2550 is my dollar selling rate. So this is not applicable to me. It's ask rate which is applicable. So I will be quoted a rate of 75.2660. 2600. Okay. Then now I need to go. I have dollar with me. I want to, I need, I need to buy a pound. So I should have a pound rate, but I have got a dollar rate. So I convert the dollar rate into pound rate. And now I know that my dollar rate, my pound is equal to so many dollars. So now the pound buying rate is what? 1.2586. So 1 pound is equal to so many dollars. So now I can just simply multiply the two and get the answer. So first I bought a dollar. Then I went to England and sold my dollar and bought a pound. So I should have a pound buying rate and a dollar buying rate. So I have both the rates with me. I have got by multiplication, I get the answer. Okay, by 94.72.
The second round answer is
94.72 and not 94.37. I don't know how you got it. So it is basically this rate, 75.26 into 1.2586. Is that right? So you said that we can, Shruti said that we can do this also. We can just, let me see, 5.26. Okay. The price is the, this will be, 75.260 divided by, it will become 0.7945. Yeah, 7945. 7945. Shruti, it should be 75.2600 divided by 0.7945 because the bid will go to ask. Now this is actually dollar in pound terms, so we have to convert in dollar terms. So this quote needs to be converted into by doing the reciprocal. So bid will become ask and ask will become bid. So it will be 75.2600 divided by 0.79264. Sorry, 7945. What I can do is I can just add one more column here. I'm just doing it for your understanding, okay? Okay, so what we can do is that we can do is 75.2600 and divide this by 0.7945. Okay, so we will get 94.72. Fine. So we can also do like this if you want. So this way also, yeah, fine. So why we have done is that we have taken 75.2 and then, we have actually we have to look at this one. Okay, this will become the relevant code. So this will become ask. Okay, and this will become bid. So we have to take the ask. So we divide this by this. Okay. So this will become ask. So this will become ask. So we need the ask rate. Is that okay? Fine. I hope you are understanding and my space is okay. I'm not moving too fast. If I'm moving, so please tell me. So I'm now going to do another exercise. Yeah, I'll share these notes. Actually, I'll be sharing these notes with the Institute of Chartered Accountants, and they will going to share with you. Okay, fine. So now let's do one more question. Now the question is that the rate between Japanese yen and US dollar is this: 119.15. 121.85. Now this is a little older. Now, of course, it is, $1 is equal to close to about 145 yen. So at the time of making the slide, $1 was equivalent to so many yen. Now this quote, which is given to you, is actually reverse order because 1 yen is not equal to so many dollar, but $1 is equal to so many yen. So remember that. Okay. And the rate between euro and US dollar are given like this. Okay. So this is the question. Yeah, absolutely. So you will get my slides with you, okay? So don't worry, you will be getting through the Institute of Chartered Accountants. Okay. So the rate between Japanese yen and US dollar is given to you. Okay. And the rate between dollar versus euro is also given to you. Okay. What will be the direct quote between the yen and the euro in Japan? What will be the direct quote between the yen and the euro in Japan? So that means we are looking for what is the price of 1 euro in terms of yen. Okay, so we want to have a direct quote in Japan because we want to buy a euro. Okay, so this is what the question is looking for. But if you look at the the quotes, they are given in a reverse order. So here the first box, if you look at, so the one dollar is equal to so many yen. Similarly, $1 is equal to so many euros. In $1, you will get less euros, isn't it? It's not like 1 euro is equal to so many dollars. Okay, fine. It will be $1 will be so many euros. So let's understand. So one US dollar is 119.15, and similarly, one US dollar is equal to so many euros. Okay, so this is like this. So first we will put the quotes in order. So these are the quotes here. So here, basically, we are saying that one US dollar. So this is $1 is equal to so many yen, $1 is equal to so many euros. So we are going to put them like this. Okay. Now, both the quotes are basically European. So we need to convert the second quote into American, because the first quote is in order, because we want to convert, we want to have the rate of dollar, euro in terms of yen. The first you're going to buy a euro, first you're going to buy a dollar, so that quote is given to you. So first quote is absolutely okay because you are going to buy a US dollar. Where? In Japan. So first quote is okay. But second quote is not in order, because now you are going to buy a euro by selling your dollars. So the second quote you need to convert it in terms of euros. So by reciprocating this thing, we got these rates. Okay. So 1 euro is equal to 1.24. It is like, 1 divided by 0.8033. So we get 1.2448, and 1 divided by 0.8021, we get 1.2467. So now we can just multiply, okay, and calculate. So 119 into 1.2488. So this is, like 1.19 multiplied by 1.24. And then 121.85 multiplied by 124. So you get the quotes. Like 1 euro will be equal to so many yen. Okay. Now bid is always lower than the ask. You're getting the same. Okay. The lower rate is the bid rate and the higher rate is the ask rate. Therefore, the rate between the yen and the euro is if you have followed how to arrive that, or should I explain it again? Yeah. Tanisha, you got the bid rate right. Calculate the ask rate also. Okay. Just to take you through again, this is the exercise where, the two quotes are given to you. Okay. Dollar versus yen and dollar versus euro. Now, if you look at the quotes, they are reverse notation, because we know that $1 is equal to 119.15 yen, and not 1 yen is equal to so many dollars. Okay. Both the currencies are in reverse notation. So we need to first we have to just put the rates in order. Okay. So we have to put the rates in order. So we put the rates in order. Clear, sir. Prashant, you got it right. Kirti has also got it right. Yeah, Anisha is also right. Okay, you got it right. So first we convert them put them in the right way. And then first I'm going to buy a US dollar. Okay. Then go to, European country and buy a euro by selling my dollars. So now I can just multiply bid with bid and ask with ask and have the quotes with me. So this is the quote. Okay, Mancha. Mancha, have you followed that? Okay, I'm just going to, for the benefit of Mancha, I'm just doing it again. Mancha, please follow this again. Now this is the, the rates which are given to you. The rate of dollar versus yen and dollar versus euro. Okay. Now you must identify these are written in reverse notation because we know that $1 is equal to 119.15 yen. Of course, little older quote because now it is 145 or something. Okay. Similarly, $1 is equal to so many yen. We know that dollar you will get less euros, isn't it? So $1 is equal to so many euros is right. Okay. So now we just put them in order. So we know that these quotes are like this. $1 is equal to yen so many, and $1 is equal to so many euros. Is that okay? So these are the two quotes given to you. Okay. Now you want to know what is the price of euro in terms of yen. Whom you are, a Japanese guy, and you are traveling to Europe and you want to buy a euro. So first, what you are going to do? You are going to buy a US dollar, and then go to your European countries and convert your dollar into European currency. So both the quotes are absolutely, you have to convert first the second quote into in terms of euros. So you have converted that because it was both were European. The first is European is okay, but the second European is not okay. You have to convert this into American code. So you have converted that into American code by just following the rules that one upon one upon ask will become the bid, and one upon bid will become the ask. So that is what we have done, and we have calculated the value of €1. Then we are just simply going to multiply and get the answers. Okay, so you get this answer. Okay. So I think most of you have got it right. Mancha, if you have not got it right, just watch the video again and let me know maybe tomorrow again when we do the chapter, and I'll explain in one of the questions there again to you. Okay. So this is the answer. Okay. Now we'll do another question. Okay. So this is a very important question. Just please focus. Okay. The following two-way quote appear in the foreign exchange market. The spot rate is given to you. Okay. US oblique dollar. Fine. Which is 46 and 42.5, and 2-month rate is also given. Now we can understand this is the quote which means that now this is a very old quote. Now the dollar is close to about 83 rupees. Okay. But about 5 or 6 years back, the dollar was trading at 46 rupees. Okay. Fine. So let's understand, the concept rather than the rates. So now we know that $1 is equal to so many rupees. Okay. And $1 forward rate is now 2 months forward rate is also given to you. Okay, fine. So two rates are given to you. One is the spot rate, another is the 2 months forward rate. So if you want to buy today, then or sell today, the rates are 46 and 46. So 46 is the bid rate and 46.25 is the ask rate. If you want to buy, then the rate is 46.25. If you want to sell, the rate is 46. Spot. Now forward rate. 2 months forward. If you want to buy after 2 months, then the rate is 47.50 as against 46.25. So dollar is appreciating in 2 months' time. And similarly, if you want to sell after 2 months, suppose you are an exporter, and if you want to sell, the rate is 47. It is moved from 46. The spot was 46. It's now become 47. Okay, fine. Now required. Okay, once I say yes, thank you. Okay, wonderful. Required. How many US dollars should a firm sell to get 25 lakh rupees after 2 months? The first question. The second question, how many rupees the firm required to pay to obtain 2 lakh US dollars in the spot market? So this is the second question. Third question, assume the firm has $69,000 in the current account, earning no interest, whereas ROE on a rupee investment in 10%. So if you have money in dollars, you don't earn anything and no interest. But if you have money in rupee in your account, you will earn 10% return. So this is given the question. Should the firm encash the US dollar now or 2 months later? The question is this. Okay. The question says that should you encash it later or should you do now? Okay. So let's answer the first question. How many US dollars should a firm sell to get 25 lakh rupees after 2 months? So now, who is going to sell a dollar normally? A guy who is in America, he's going to sell dollars and he needs, he's going to sell rupees and he's going to get dollars. But now the quote which is given as a direct quote in India. So first, you should convert this quote in terms of rupees. Okay. Because you want to sell 25 lakh rupees. So 1 rupee is going to give you 1 divided by 47.50 dash 1 divided by 47. So you have converted without, solving it further. So you have got both bid and ask rates in terms of rupees. Now you want to sell rupees. So if you want to sell rupees, then selling dollar means buying rupees. Okay. So which means 25 lakh divided by the ask rate. So you are going to buy, So which means that you are going to buy rupees. Now you should look at the ask rate. So when you are selling rupees, that selling dollars, it means buying rupees. So you should be looking at buying rupee quote, which is the ask quote. So 25 lakh rupees divided by 47. So you get 5319. Yeah, you're absolutely right. Okay. So this is the first answer. Is it clear to all of you? So the first question was, how many US dollars should a firm sell to get 25 lakh rupees? So that means you are an American, you're an American firm, and you want to, sell, dollars, okay, to buy rupees. So your quote should be in terms of rupees. So the quote was in terms of dollars. So first we converted into in terms of rupees, okay. Then you want to, sell dollars and you want to buy rupees. So that means you should look for the ask rate. So this will be 25 lakh rupees into 1 divided by 140 by 47. So you get this. Is that clear to all of you? Is that clear to all of you? Please raise. Tell me if you have got it. We can move to the second one. Sell us and buy rupees. Sell US dollars and buy INR. Very easy. The second question says that how many rupees the firm required to pay to obtain, 2 lakh US dollars in the spot market. Now the spot rate is given to you. Okay. The spot rate is given to you, which is 46/46.25. So you want to buy dollars, isn't it? And you have the dollar rate. The dollar rate is 46/46.25. So for buying dollars, you have to pay 46.25, which is the ask rate. So dollar spot buying rate is itna. So you can just multiply simply and calculate the rate. Is that okay? Fine. So that means you will get 92,50,000 rupees by selling your $2 lakh. So it's a straightforward question that how much money you're going to pay, how much money you're going to get in terms of rupees if you have $2 lakh and you want to convert your $2 lakh into rupees. So it's a normal case. You go to the bank and look at the quotation, So you look at the Indian quotation that $1 is going to cost you 46/46.25. Now, since you have to buy, buy dollars. So dollar buying rate is 46.25. If you have to sell the dollars, then the rate was 46. But now you want to buy dollars. Okay, dollar spot buying rate is 46. So you want to convert this into, rupees. So you are going to multiply it by 46. So $1 is equal to 46. Okay, so this much of rupees, how many rupees the firm required to pay to obtain? So you want to buy dollars. So that means you need the ask rate, 46.25. So 2 lakh multiplied by 46.25 will be 92 lakhs. Ask rate to buy dollars. That's right. So 46.25. So this is a normal quote, when you go to the market and you want to, purchase $2 lakh. So you have $2 lakh with you. Okay. You want this $2 lakh. So you should have 92,50,000 to purchase $2 lakh. That's it. Okay. The third one. Assume the firm has $69,000 in the current account, earning no interest. ROI on rupee investment is 10% per annum. Should the firm encash US dollar now or 2 months later. Fine. So first is we have to understand is encashing $69,000 now versus 2 months later. The spot rate is 46/46.25. So you have 69,000 with you. You convert that now, the rate will be 46. So you'll be looking at the bid rate. Now you have $69,000 with you. You want to convert them into Indian rupees. You want to sell the dollars. Okay. So you will be looking at 46. So you have to look at the bid rate. So if you encash it, you get 31,74,000 rupees. If you encash it now. Okay. But now if your account is now with Indian rupees, you're going to get 10% rate of interest. So 10% means 10 upon 100 for 2 months, you will get 52,900 rupees as interest. Now you did was you had $69,000 with you. Okay. The first option was to encash it now. So you encashed it. When you encash it, you will get 46 rupees, not 46.25. If you want to buy, you will get 46, but if you want to sell, you are going to get 46. So the moment you sell your $69,000, you will get 31,74,000 rupees. Now your account will give you 10% return, because in the question it is given that you're going to get 10% return on the money which is lying in your account. So you will get another 52,900. So that means the total money you will be getting would be 32,26,900. Okay. So this is when you encash it now. Now, the second question is, if you want to do it through the forward, that means you are going to do after 2 months. So after 2 months, the dollar becomes 47. So you are going to get 47 rate. So 69,000 into 47, you're going to get 32,43,000. Now, when you did at the spot rate, you got 32,26,000. The forward rate was 32. You got 32,43,000. So which is better? It is better to encash the proceed after 2 months. Is that okay? Have you got it right? Yes. Namrata, you're right. 32,26,900. So now we are just comparing, which is a better one, to encash it now or to encash it after 2 months. When you encash it now, okay, when you encash it now, let's go back. When you encash it now, then, you get basically is rate of 46. Okay. You convert all your dollars into rupees, and for 2 months, you're going to get 52,900 as interest. Now you're going to compare it with the option of, encashing it after 2 months. So you need to add interest here to make both the numbers comparable. So here, the total rupees, after 2 months you will have in your account will be 32,26,900, which includes an interest of 52,900 for 2 months at the rate of 10%. Though you got 31,74,000 immediately by encashing in the spot market, but your money was lying in a bank account and which earned interest of 10%, and then your money grew to 32,26,900. Now, the other option was to wait for 2 months and convert your dollars into rupees after 2 months. So you did that, and you got 32,43,000. Okay. Now, if you compare both the options, the spot versus the forward, you find that forward is giving more money. So it is better to encash it after 2 months. Okay. This type of question. Yeah, this was a CA question. Okay, and came in long back. Sir, please explain the interest part again. I'm getting confused by taking 2 months. It should be fully. No, we have to take 2 years. Okay, yes, it's better to encash it after 2 months. Yes, sir, it is not spot interest rate for 2 years. No. Now look at this. Here the 10% ROI is per annum. Okay, look at the question. Okay, assume the firm has $69,000 in the current account earning no interest. ROI in rupee investment is 10% per annum. Okay, so if you use your calculator, I'm just using it, and you can just open your calculator. So let's calculate both of us together. Okay, then we take 31,74,000. You just put this number into 10%. So for full year, you will get 3,00,000 suppose I'll just add, here one more, or I add here one more, add one more shape. Okay. So here I'm saying 31 lakh 74,000 into 10%. So I get a figure of 3 lakh 17,400. So this is for whole year, isn't it? But I want my money will be lying and will be for only, I have to divide by 2. Okay. And then multiply it by 2 for 2 months interest. So this will come to 52,900. So I'm just putting it back again on the slide. So it is like, 31 lakh 74,000 into 10% will give me 3 lakhs 17,400 for the entire 12 months. But I'm going to put the money only for 2 months, isn't it? I'm not going to park it for, full year, because I have to compare with the option of 2 months forward. So this will be 52,000 forward. Yeah, absolutely. So have you followed now? There's no problem with the latest part. Is it okay? So what you do is you got 3 lakh 17,400. You divide this by 12. So you'll get 26,450 multiplied by 2 months. You get 52,900. Okay, because this interest is per annum. That means this is the interest what you are going to get for the whole year. But you're not going to put the money for whole year. You're going to only put for 2 months, just to check whether this is better or the option after 2 months when you encash it using the forward rate. So you have to add only 2 months interest on that, not for the whole year. So that is the purpose basically. Okay. So you mean we are equating spot versus forward? No, we are just looking at that, we are just looking at the two options. Should I, convert my money now, or should I convert my money after 2 months? So I'm just looking for the options. कि अभी convert कर लें या 2 महीने के बाद convert कर लें. अभी convert करता हूं तो I get 10% rate of interest. I use the spot rate. But if I convert after 2 months, I'll convert at the forward rate. But there I'm not going to get any interest because I'm going to view both the options. So I find the forward rate was better because I was getting 32 lakh 43,000. Now I think it is clear. Okay. So, okay, this I'm going to skip. This I've done on a, you can just do this exercise of your own. But anyway, I'll just skip that. Okay. Because this I did in the near rates, because this came a long back. So I converted to the, current rates of 83. So I'm just going to skip that. So now we come to the last topic of the day, and then some quiz. Okay, pips. So what is a full form of pips? It is called price interest points. Pips. A pip, short for price interest point, represent a tiny measure of change in currency pair in the forex market. Now we all know that the currencies are put. So for example, I just add one more box here to explain that a little better. You know that, $1, USD 1 is today trading at 83 or 82.954. For example, suppose this is the price. Okay, fine. So this is the dollar price, assuming this is the dollar price today in the market. Now the pip is the fourth decimal place. So this is pip. Okay. Now suppose it moves to after some time. Suppose it moves to USD 1. Because the price is going to change every second or every minute. Suppose it goes to 82.9575. Okay. So here the price has moved by 10 bips. 10 pips. The price has gone up by 10 pips. It was just a minute back, the price was 82.9565. Now the price has gone to 82.9575. So difference is how much? 10.0010. So the price has moved by 10 pips, what we say. Okay. So let's understand this more. Okay. A pip is the smallest price move that exchange can make. Okay. Most currency pairs are priced out into 4 decimal places. The pip is the last decimal point. Okay. In Indian interbank market, USD INR rate is quoted at 4 decimal points. Okay. Hence, the minimum value change will be to the tune of 0.001. Okay. So a pip is the smallest whole unit price move that an exchange can make based on forex market convention. Most currency pairs are priced out to 4 decimal places, and the single pip is the last decimal place. Okay, the last decimal place is called the pip. For example, the smallest whole unit move between a USD and Canadian dollar currency pair can make is $0.001. So if we say one Canadian dollar is equal to how many this thing, so it will be $0.001. Now, if this currency, what is written is, I can just add another box to explain that. For example, one, I don't know what is the price of the cat today. Just let me check on my Google. Just what is the price of Canadian dollar? Just check it. One Canadian dollar versus dollar USD. So this is 0.7424 or 25, sorry, 25. Fine. So this is the point here. Okay. Suppose now after some second the price moved to 0.7426. Okay. So how many pips it has moved? 0.001. Okay. Fine. So this is the smallest movement in the currency. It has moved from 0.7425 to 0.7426. So that last digit is called the pip. Okay. Now key takeaways. Foreign currency pairs are quoted in terms of pips, short of 4 percentage points. Okay, now I'm just going to skip that and just show you the last slide. Now, look at this slide, price interest point. Spot USD UR quoted at a bid price of 1.2313 and the ask price is 1.2319. The difference is 0.06 or equal to 6 pips. Okay, so this is equivalent to 6 pips. So look at some more here. The last decimal place is called the pip. So 1.1402. So this is Euro USD currency. So the fourth decimal place is called the 2 pips. Okay, fine. Or the difference between ask and the bid price is 6 pips. Yeah, only the last. That means what can be the minimum move of a currency? Like, for example, we saw that if it moved by 1 pip, so here we have seen the difference between the bid and the ask is 6 pips. Is that okay? So that's all basically. You don't have to. I mean, of course, this is used more in the stock exchange terminology because in stock exchange, people don't talk about how much dollars they have earned. They'll say today I have earned 10,000 pips or 2,000 pips. Okay, without referring to the currency in which they have traded, but they will say that today I have made 5,000 pips. Okay, so 1 pip may be equal to say $1 or something. For example, let me just give you an example here so that you can understand. Okay, this I'll do next time. So we are short of time, so I'm going to do a quiz also for you. So we'll cover maybe tomorrow. So let's just have a recap. It is a smaller unit by which the currency quotation can change. Okay. So just focus on your slide. It is the smallest unit by which the currency quotation can change. Okay. So USD INR quoted to a customer is say 61.75. So minimum value this rate can change is 61.74 or 60. Suppose it is up to 2 decimal places, but normally it is up to 4 decimal places. To just understand the concept, I made it up to 2 decimal places. So it can be either be 61.74 or it can be 61.76. So the currency can move either less or more. Okay. So in other words, the USD INR code, the PIP value is 0.01, but normally it is up to 4 decimal places. Okay. So it is corrected here in my second slide. However, the Indian interbank market USD INR rate is quoted up to 4 decimal point. Hence, the minimum value change will be the tune of 0.01. Okay. So, for example, yeah, it is called a spread also. Yeah. But then the spread is how many pips? 6 pips. Okay. Let's look at this. Euro USD is quoted at a bid price of 1.2313 and ask price is 1.2319. The difference is 0.006 equal to 6 pips. Okay. So Satish Kumar, you're right when you say it's a spread, basically, but of course, how we are saying it, we are saying it is having, the difference is 6 pips. Okay. So that concludes my, the topic for the day. So let's have some, quiz before we close down for next 5 minutes. Direct and indirect quotes are dash of each other. Reciprocal, proportionate, equal, unequal. Just answer this question. Direct and indirect quotes are dash of each other. So, Satish, you said standard deviation. So, it is not the standard deviation. It's not the volatility of the forex market rates. PIP is not that. Okay. So, we're going to discuss that tomorrow, maybe. So, answer this question, please. So, standard deviation answer is A. Absolutely right. Next question. Okay, Shankarada, the class is very useful. Okay. Any other comments for anyone? I mean, did you find the class was good? You could understand everything? So please put your remarks. So Shankar Rao was happy with the class. So if you want any kind of a more change you want, I can make. So any suggestions you can just give me. But in the meantime, just answer this second. Direct quotation is when the one unit of foreign currency is expressed in terms of. Okay, Viraj, sir, you have explained greatly. Bid and ask, bid, direct quote, and indirect quote. Thank you for clear concept. Wonderful. So that is my purpose, basically. And if you're finding it useful, so I'm very happy. So direct quotation is when one unit. So, if you understand all these basic concepts very well, you will find all the questions very easy. The questions are very, very tough in the CA final, particularly Forex questions. But if your basics are clear, I think you will never make a mistake. That's my, guarantee to you. Okay. Okay. So the answer is C. Yes, the answer is C. Okay, so the third one, indirect quotation is when one unit of domestic currency is expressed in terms of indirect quotation. Indirect quotation is when one unit of domestic currency is expressed in terms is on a GM. So I just made a mistake here. So the answer is C, foreign currency. Yeah. Okay, Shruti, thank you so much, sir. The class was very nicely explained concept. Thank you very much, Shruti. And I hope to see you again tomorrow, okay, and understand more concepts. Okay, the fourth one. Bid is the price at which the dealer is willing to dash another currency. What is the bid? Okay. So any other comments with regard to the usefulness of the lecture, today's lecture, you find you're able to understand? Kusma, Kumari Jyoti, anyone again? Okay, so the answer is B. Answer is B. Fourth is B. Bid is the price at which the dealer is willing to buy another currency. Okay. The answer is B. Okay. Maybe that I think is still referring to something else. Okay. Fourth one. Buy. Okay, Mansha, very good. Very happy to note, Mansha, you are understanding the concepts, and I hope you would like to understand all your futures, options, forward. So I'm going to explain them in a very simple manner so that you will understand even the futures and options and everything swaps so easily. So don't worry about it. I'm going to do all difficult questions in a very easy manner as you have done today. Okay, fine. So the fifth one, the ask or offer is the rate at which he's willing to another currency. So he means the dealer. So Prashant says every concept is clear. Thank you. Wonderful. So you'll find, even the basics you'll find it so easy to understand. Even the tough questions you'll find very easy to understand when we'll be doing, in next 6 days or 5 days left. Okay. So answer the fifth question. A. Yes. A is the right answer. So now sixth. So this we have done actually. This we have done. 8. So exchange rate expressed by any currency pair does not involve dash is called the cross rate. So the eighth one, have a look at the eighth and answer. The dollar. Yes, the dollar is the right choice. Ninth. Okay. The spot euro versus USD is quoted at a bid price of 1.0213 and the ask price 1.0219. The difference is 0.06 equal to 6 what? Pips, swaps, cents, points. Yes. Definitely. I am join me again in the next 5 days to understand this topic, which you are going to not face any problem in understanding all the concepts. Okay. The ninth one is called pips. Okay. Okay. Let me just put on. Let me just see which is the another question which I get. 17th one. Okay. When the value of British pound changes from 1.25 to 1.50, then, okay, the answer is actually given here. Okay. Okay. When the value of British pound changes from 1.25 to 1.50, then, which is the correct answer? As we are much faster than you. And even if it is not right, they are not dividing all of it. So answer is meeting is very useful. Even classes they don't see that's good. The pound has appreciated. The pound has appreciated against the dollar. Okay. So we close the lecture today. So we will again see you tomorrow morning. Thank you so much for attending the class. It was really well that you people have learned all the things and you found the class was useful. So tomorrow we'll have another useful session. Okay. So see you tomorrow morning. Ashok.